we truly started to change that longer term outlook, I would say post-pandemic, observing the supply chain issues and inflation caused thereby. This resulted ultimately in the change in rates in 2022. And for me, that is definitely the start of a new era.
Welcome to Private Capital Call, the podcast with leaders in asset management, investing, and capital markets. I'm your host, Randy Schwimmer. This month, we welcome Marcel Schindler, partner and head of private debt at StepStone Group, a global private markets investment firm providing customized investment solutions, advisory, and data services. Marcel leads StepStone's global private debt platform and is actively involved in both investment and management initiatives. Marcel, it is an honor and a pleasure to have you on Private Capital Call.
Pleasure is on my side. Thank you very much for having me, Randy.
So we always like to start these conversations with thought leaders, with looking at the macro outlook. It's been more interesting this year, I think, than any year I can remember, because there's been so many variables and so much change. We're recording this in mid-June, and it just feels like we've been through 3 years in the last 6 months. Give us your sense of where we are in the economy and in sort of markets, and thinking, of course, about the market reaction to tariffs, which has been a little bit more muted than is expected, probably because tariffs have gotten a bit of a reprieve in some situations. But maybe kind of give us your global view of how things are looking right now.
Very happy to do, Randy. And let me start a bit with the macro and then maybe go a bit to market reactions, which is always a bit more challenging. At StepStone as a private market house, we obviously, when we talk about macro, we talk long term. And that normally we expressed in our views in our capital market assumptions, that's a view 8 to 10 years. And we truly started to change that longer term outlook, I would say post-pandemic, observing the supply chain issues and inflation caused thereby. This resulted ultimately in the change in rates in 2022. And for me, that is definitely the start of a new era. Sometimes I believe we all have the feeling that cycles need to end in a big bang. And truly, I think we entered into a new area in 2022. I would say a number of changes, the reversal of the low rate environment, kind of this higher for longer, structural changes across industries and geographies. I would call it deglobalization. And as a consequence, probably lower global real growth rates, ultimately, as an expectation. And in light of this, if I think about the tariffs now, it is not really necessarily a new event, or all the policies in and around the tariffs as well. I would say it's more going in the direction, again, of deglobalization, nations first. And I'm not talking about the US, others take measures as well. And again, this means to me just in a first phase, negative impact on global growth. It will create new winners and losers in industries and geographies, to my mind. And definitely it creates a lot of uncertainty, which means translated volatility. That's what we experience, at the beginning. And here with the market reaction, I believe the first market reaction was completely in line with our expectation, trading down. But where it trades currently, surprises me. And it obviously trades on a lot of expectation beyond what I actually see fundamentally.
Do you think that where it's trading now is completely discounting the potential of a return of more authoritative tariffs in certain areas? Or why does it feel like it's trading a little bit higher than it should?
Interesting question. Probably I don't have the explanation, but let me, how we thought about the tariffs was more kind of like in scenarios, no? And I would say our best scenario was kind of a trade deal. And in a trade deal, I would say we shaved off the GDP expectation pre-Liberation Day about 50 basis points on, which I think is a very reasonable assumption with uncertainty and whatever happened, that will have a GDP impact.
Yeah.
But equity markets have traded up since then. So I have hardly any explanation.
For your model, maybe walk us through a little bit the methodology and how that works.
Yeah, for us, the alternative of having a crystal ball is kind of thinking in scenarios. And accordingly, we created a model that helps us. We are currently across our platform invested in approximately 1,500 private credit deals. And the big advantage that we have is we get on a quarterly basis the fundamental performance of the underlying borrowers, but as well the financial data. And that allows us actually on a quarterly basis to rate about 1,500 credits across the US and the European market. And I think that's quite a representative type of number, especially what it allows us because we use an internal rating methodology, but use as well public data in the background. It allows us now to stress the fundamental data. Depending on GDP, declines across the market. Always declines because we're in credit, as you know. I don't need to model the upside now.
Yeah.
It's only downside to think about. But what we do is we stress the GDP 50, 100, or even in negative GDP scenario. And that leads to rating migrations. And obviously with rating migrations that you create across a portfolio of 1,500 credits, you immediately get to new default assumptions and implied loss rates. And that is really very, very interesting then to analyze and think about what happens. And as I mentioned before, the best case scenario for us was trade deal, 50 basis points off. What happens in 100 to 150 basis points off, and what potentially happens if we go into a recession. The first two scenarios look both good for private.
And for those 1,500 companies, are those classic middle market companies? How would you describe them?
Classic middle market companies, I would say the average EBITDA, probably the median, is around 50 to 55 million.
Okay.
And so it really represents nicely, I think, the core middle market in average.
And industries across the board, or are they more?
Across the board, absolutely across the board, broadly diversified, yes, and including Europe as well.
So when you look at industries and you run your methodologies, we historically, at Churchill have found that business services tend to do better in cycles. And there's some industries which definitely don't do better in cycles, right? The energy, housing, real estate, and so forth. In your analysis, do you see changes based on sectors that you can use to say, well, if we have another trade type of event or tariffs get doubled down or so forth, that allows you to make some conclusions future shocks?
Yeah, interesting. Obviously, similar to you, we looked as well at public data and our database, which goes then over 30,000 loans. And obviously that shows pretty much which, as you said, business services and which industries are a bit more resilient, to a GDP decline. But what we did this time, obviously, which was very specific, we looked at the most highly impacted type of industries. And what we did there on top of actually not just, increasing default assumptions, probably at the end of the day, we were very harsh in the assumption in terms of recovery. Imagine, for example, if a supplier in the German automotive industry of mid-size, very hard if they were export oriented into the US to recover in that business. So in general, on every highly impacted sectors, we took recovery assumptions of 25%, which is probably the lowest that you've ever seen.
Yeah.
And still across the broadly diversified portfolio, a lot of resilience in all the scenarios actually.
So if you think about, you mentioned higher for longer, think about where the Fed is right now. They seem to, I think I saw a headline before we jumped on, the Fed's taking the summer off. It sounds like maybe the fourth quarter, there may be a rate cut. I think I've seen one for the fourth quarter, potentially two, but then drifting into next year. What is your sense of where we're headed from a rate perspective?
I never predict rates or currencies, because I'm always terribly wrong, first of all. But obviously, as we know, it's a function of inflation, the GDP growth, and the job development. And the only thing that I can say, looking at the numbers, especially in the US, I think the Fed is in a comfortable situation still. And why should they react too early potentially? So I just get the feeling they're not in a rush, and I understand very well because they were a long time in an uncomfortable situation at lowest rates where they had no room to maneuver, which they now have. Obviously, that view is probably very different for Europe, where maybe deflationary pressure comes up and rates need to move different.
Do you think, because one of the big questions that comes up at conferences, I'm sure you're dealing with the same thing, is depending on where the macro is, if you're viewing the chance of a recession being higher as a result of higher rates, you're going to have a different perspective in terms of risk on versus risk off. I'm sure that as LPs, you deal with investors who are in the public markets and who are seeing the volatility and correlation, which has historically hurt investors during times of volatility, and they've sought shelter in private credit during such times as these. And while the markets have calmed down since April 2nd, it's certainly, let's put it this way, there seems to be more potential risks down the road that could ignite future volatility. Are you seeing LPs thinking more and adjusting their own allocations based on that uncertainty? Because uncertainty seems to be the key word.
I'm not so sure that private market LPs are really driven by uncertainty. No, I think about it in the way that you need to be risk on to allocate to private markets because we're in a risky asset.
Yeah.
Number one, I think that's very important. But what I've seen, obviously on the LP side, coming back to the macro statement that I made at the beginning, is definitely lower growth rates, that concern them. And I would say this balance between debt and equity tipping in favor of debt, obviously in a low growth environment and higher rates. So nominal yields going up. And on a lower growth rate, actually, debt does pretty well, whereas equity obviously doesn't have as much upside potential. That's a major, I would say, shift in the LP allocation that I have seen, meaning not just shifting actually into direct lending as an example, as a fixed income replacement, but even considering from an equity perspective to allocate into direct lending or private debt in general.
And does that include equity strategies?
On the private debt side,
yeah,
partially within, I would say, within the opportunistic allocation, there is probably a certain equity bucket allowed normally, but I think within the risky assets, they look for the saver trade. They want to go up capital structure. I would put it like that. First you have debt versus equity, and then within the debt, they go up the capital structure in tendency. You can clearly see this in all allocations.
And is there, certainly with our investor base, every time we ask them whether they're interested in more private credit, they say yes, by a wide margin. Yes, we want more private credit. We're both maintaining and increasing our exposure and allocation, and they seem to be driven by the same things they've been driven by for a number of years, which is less correlation. They've got plenty of movement in public assets, and they want to hedge against that. The yield is still attractive, as we talked about. The Fed's not going to cut, and you're still getting, call it a 10% unlevered yield in senior debt right now, which remains attractive. Spreads, I'd love to hear your view, but spreads have over the benchmark have really not changed in the last 18 months. We saw a significant change when the public markets came back to life in January 24. But since then, you're still kind of seeing kind of a SOFR plus 500, give or take. Maybe a little less for better credits, a little more for some, more risky credits. Is that your sense as well?
I would confirm. Obviously, people, now they were talking about the spread compression, but they talk about peak to trough, which is obviously, and then, yes, there was significant compression. But I agree with you. Spreads in a historical context are absolutely in the normal band, as well. When we measure always, obviously, the spread per turn of leverage as well, as one kind of risk adjusted measure. And we're absolutely in the normal band of what we have seen. And I would agree, depending on the good deals and the bit larger ones, probably you're more in the 475, but we see going up to 550, 475 to 550 is probably what we see most in the current market, and that is an absolute reasonable level, actually still very attractive compared to the public markets.
Yeah, I wish we could get that word out to more people, but this is why we're having this podcast, because you hear in the media, spreads are compressing and defaults are increasing, and we just don't see that. Yes, is there a risk if we go into a recession? Obviously there is, but then all asset classes are challenged.
That is the point that what I'm normally, I see in the news journals are full actually about this concern about credit. My first question is always, did you already sell all your equity? You know?
Correct. Yeah. And I think as I was at the Moody's conference last week, which was it's their first private credit conference in New York. And they've done their homework. They've got a team now that's focusing on private credit, and they've done their homework. They had good speakers who were speaking about the landscape. It was a great event. And one of the speakers, as a large cap manager, was saying, why do they talk about private credit risk and not talk about public credit risk when bonds go out in a problematic deal trading at 40 cents on the dollar? Like, okay, where's all the critics when that's happening? And obviously, that's a different topic, but it raises the question, I guess, from a relative perspective. Yes, private credit has not been fully tested. Obviously, if you, like we were around before the GFC, and we started in 2006, so we went through the Great Recession, and very few managers did. I think about 5% of all private credit managers were around back then. So we have been tested, but one of the analysts said, if you haven't been, then it's just been a quiz, not a real test. But then look how public credit did during those quizzes. They didn't do so well in 22 and 23, did they?
Absolutely. No, I'm with you. And yes, a lot on the GP side, probably many have not been tested. But nevertheless, the other means that might help is sufficient diversification. We did a lot of analysis as well around diversification in the credit portfolio and staying really first lien. The question is always, are you really first lien or somewhere else in the capital structure? Sometimes a bit of misunderstanding what is first lien and what is not. But first lien and good diversification normally help in any drawdown situation.
And speaking of diversification, I think one of the signs that private credit has matured is that the tools that are being used now have become much more sophisticated. CLOs is a perfect example, how structures within structures, CLOs within BDCs and so forth, secondary market, NAV lending, and there are other examples. But from your perspective, Marcel, talk about how sophisticated private credit has become and where it's headed.
It made huge developments over the last 10 years, if I think about it. I still remember 15 years back, we still had to explain in certain geographies the difference between a loan and a bond. Where we are now, it's really getting much more sophisticated. And now with the instruments, let us go at the CLOs first, because they might be a bit different than the others that you touched on. On the CLOs, I would say, two use cases that we see. You mentioned the BDCs, obviously optimizing the liability structure. That obviously is actually very helpful for the GP, but I think as well, looking at diversification, the investors get, it's an interesting and attractive investment. CLOs as well, for those that issue as a longer term kind of instrument, and having a more stable capital base can be extremely helpful to middle market managers overall. So we like the risk return characteristics of CLOs. If you are with the right manager, as always, very clear. The other, obviously, you touched on NAV lending and secondary market. Look, NAV lending, obviously a liquidity tool like the secondary market in general, financing PE funds, obviously that have some liquidity issues in general, not unattractive in principle, but I believe on the senior structure of the NAV lending side, it got a bit tight, and I don't see that much attractiveness, but there is a lot of competition in there. The banks are even coming back in that space, and that means, a bit the stretched, or I would say preferred equity structures, you see a bit less of them, and so there's not that much volume in that space. And the last one, secondary market, GP-led, LP-led, my point there is, I think investors need to be a bit cautious when thinking about the secondary market in general. Everybody sees these graphs that are extrapolated from the private equity secondary market, and everybody says, direct lending will be the same like the private equity ones. And I have some doubts for multiple reasons. Shorter term instruments, first of all. Yes, you normally get cash relatively fast back compared to private equity. And you don't have many years like 2022 where you really need liquidity, and fixed income and equity are down 16%. It's clear that LPs trade in an environment like that, but maybe not necessarily in others. And the other point is probably from a seller perspective as well. When you sell a direct lending portfolio, you automatically with a discount will realize a loss. So the mentality of selling, you sell a good private equity portfolio at a discount. You're still, from an unrealized gain, you go into a realized gain. It's very different. And so then obviously the portfolio that you buy as well in credit, you always buy tail-ended kind of situations. If you think about tail risk, whereas private equity portfolios, as you can see as well, when you look at the distribution of the returns of secondary funds, are much more normal distributed than actually credit risks. And so there are a lot of differences, and I'm not so sure if every participant in the market is that much aware where all these differences are.
And I think also the capabilities of the private credit managers are expanding. And I think to the extent if you don't have it in-house, you're going to need to buy it or you're going to need to merge with it. And you have obviously been in a position to see the industry consolidating and partnerships being created, even bank and large private credit managers, although I think it's too early to tell how those are going to fare. But I assume that this industry consolidation is generally good and it's probably going to continue, but would love your thoughts on what you're seeing.
Look, it's like always, I believe, the industry was growing significantly. Not just in absolute size of dollars invested, but as well in number of managers in the market. And we might probably agree there might be more GPs than needed in the market at the end of the day. So it leads to a consolidation. And that is driven by the necessity to get to scale and by the difficulties probably to raise capital. Capital raising is not as easy anymore. And so you see that the GPs need to look for possible strategic partnerships very often that support capital raising or seed new products. Others try to buy insurance balance sheets, to expand their scale at the end of the day. Some get desperate and go into price competition. So you see a bit of everything, but it's a clear sign that there is more consolidation. And for the LP, that means probably to be a bit more careful when selecting to invest in which type of GP.
Let's talk about that because I often get asked about the crowded market, quote unquote, the supply and demand. There's too much money chasing too few deals. And it certainly on the face of it, it looks like a crowded market. It seems like there's new funds all the time. But, knowing a little bit about your platform and certainly knowing a lot about our platform, we've got plenty of deal flow and we can be very selective. How do you talk about that, quote, crowded market? Because a lot of it comes down to, there are a lot of players, but everyone's so specialized now that we're doing different things. But how do you allay those concerns that there's just too much capital?
Talk about supply and demand. I always think as well a bit shorter term and longer term. And I think shorter term, we're in a kind of imbalance. Longer term, I see it working out. If I look at the relation of dry powder between equity, private equity, and private debt, relation about 5-1. Okay, not all that capital goes to private deals. Obviously, public debt will be used as well. But still, you have a healthy relation actually overall. Now we have very low deal activity that we know. And within this lower deal activity, actually, there is obviously more competition in and around the number of deals coming to market. But that's a shorter term kind of imbalance that I actually see. So that should balance out over time. Then probably what adds to this kind of imbalance currently is as well the rise of newer structures like open-ended BDCs and other situations has added on top to this imbalance. And what I say, they need to permanently invest. And this shorter term, longer term kind of misbalance that I mentioned before is as well. As we all know, private equity normally can wait because they're paid on committed. Direct lending managers are paid on invested, as we know as well. So there is a kind of misalignment to some extent. I think that all winds up because we have now a bit this DPI problem over a couple of years on the private equity side, and they need to move forward, I think.
So just to wrap up this conversation, I think this is where a lot of investors are kind of thinking about the future and certainly the growth of private credit, which the estimate for the universe, which is about, I think we're at close to 2 trillion, and there's been estimates going up to 3 and 3.5, 4. But if you start throwing in other categories, and certainly in terms of the wealth sector, which has been, barely tapped in some situations, then, numbers like $40 trillion of potential wealth that's sitting out there. I think it is fair to say that with the public markets and certainly the banks pulling back on just lending in general, if you look at opportunities, things like infrastructure and data centers and technology going forward over the next 10 years, there seems to be a huge amount of financing opportunities that, let's call it broadly, the private markets can be very helpful, both in terms of just the scale, but also the adaptability and resourcefulness as to how those loans or quasi loans are constructed. Maybe just end on a positive note in terms of where this industry is headed from that perspective, Marcel, and what your view of the opportunities are longer term.
I share your view about this quite unlimited need for financing going forward, because as you correctly mentioned, the banks have limitation, balance sheet, regulatory, and they prefer from an equity return, actually the commission-based business anyway, not lending with the balance sheet, and public markets not being adapted necessarily to lend into each and every situation. And I think, as you mentioned, that shows a significant growth. We haven't touched now on ABL and ABF as an example, asset-backed lending and asset-backed financing principle, which is a huge area already now, and has more and more demand going into private IG and so there is, I believe, there is a lot to come, a lot that develops. Capital is needed. It's not enough there yet.
Marcel Schindler, partner and head of private debt at StepStone Group, a global private markets investment firm providing customized investment solutions, advisory, and data services. Marcel, thank you so much for joining us on Private Capital Call.
Thank you very much for having me. It's a real pleasure. Thanks a lot, Randy.